if you have 5 minutes to discard a company or choose a company for a deeper study, right? What are those key factors that would help you make up your mind either way?
Yeah, I mean, I think what you want to look for is, first of all, you want to. It's pretty easy to tell if a business has great economics or not.
Hmm.
Return on equity. Just intrinsically, does it fit in your head as a great business or not? Right. So so I'll give you an example. Just I'll digress a little bit and come back.
Right.
Uh, I've always had difficulty understanding Amazon's business model. In fact, the business model never made any sense to me.
Hmm.
I order a box of Band-Aid, which costs like $4 or something, and it's delivered to me next day at the $4 with no shipping charge. The real cost of getting that to me has to be north of $10 or $20. There's a guy driving a truck, and there's a warehouse somewhere, and there's multiple warehouses. I mean, there's a whole back end stuff going on to get that Band-Aid to me, and it shows up at the $4 price, and Amazon has a $1 margin on it, 25% margin. They have a $1 margin on that, and I think the last mile costs are ridiculous. So to me, it never made sense that this was a good business. And every time I look at Amazon in about 2 minutes, I'd say. And then recently I was listening to Jack Ma, Alibaba, and he says the exact same thing. So he says this makes no sense to us, right? And so he is not willing. Jack Ma has not taken uh, ownership of the inventory, and he doesn't control the distribution. He controls the digital pipe, and there's someone else doing the deliveries and someone else who's taking the inventory risk and all of that, and he's sitting in the middle of all that with the payments and the pipe. And that model makes sense to me. The Amazon model doesn't make sense to me. And Jack Ma said, look, I have 25,000 people. This was a few years back. If I go to the Amazon model, I need 10 million people. He said, I'm having difficulty managing 25,000. I don't know how I can manage 10 million. So I'm not going to go there. So it was two very different approaches, right? Now Amazon has made it work. Eventually, basically, they made it work. And Alibaba has never gone there. The negative with Alibaba's approach is the link to the customer is not as strong. The Amazon approach is you're just locked in. We love Amazon, and so there is a kind of ebb and flow there, right? So, but for me, the thing is, if I was looking at Amazon 30 seconds, I would just not be interested because it intrinsically doesn't make sense. If I looked at something like MasterCard, it would very quickly make sense because they get a certain percentage of every transaction, and it's a bunch of servers. So you I mean, it's going to be 80% margin business because after you have scale, every incremental transaction almost has no cost. So very quickly you can tell very quickly if a business has great economics or not. That doesn't take much time. What does take more time is the durability. So you can tell whether a business is a good business or not. The second question, is it durable? That's a much harder question. And you have to run through in your head, if you're going through the 30 seconds, you have to run through in your head all kinds of things about durability. And the easy way. So I'm reading a book by this guy Terry Smith. Terry Smith runs Fundsmith in the UK, I think 30 billion or whatever under management. So his answer is, he said, look, I don't want to pick winners. Okay, he said picking winners is very hard. I want to call the winner after the race is ended. Okay, so he says that basically once the race has ended, we know who the winner is, and that's who I want to invest with. So what he means by that is, he says he has no interest in any companies which don't have a very long history. So he's interested in Nestle with 150-year history, where I think there was one quarter they lost money or something, or like Colgate, Palmolive, and so on, right? Or Microsoft or whatever. So he's saying these companies already won. Okay, Nestle has won, Microsoft has won, all these companies have won. So I just want to look at all the winners and then just pick from those, right? So his approach is, we know the return on equity is high. We know that they have durability because they've already shown they're durable. Who's going to take Nestle out, right? Who's going to take Unilever out? So his approach to that is, I'm going to answer the question in a simple way, which is, the race is already over, right? So I think that if you use those two models, if you just have the durability and the return on equity, those are the only things you looked at, you could pretty much in 30 seconds get there with a lot of businesses.
There are more than 4,000 listed companies in the US, 5,000 plus in India, and over 58,000 companies across the world. So the real question is, how on earth do you assess them quickly? And more importantly, how do you decide which ones are worth buying and holding for years? It all starts with one fundamental question. Is this a durable business? Because durability beats speed. Some businesses can't be assessed in 5 minutes, but a few great ones can. Their long term strength is visible instantly. Remember what Warren Buffett said: time is the friend of the wonderful business, the enemy of the mediocre. A long term winner with consistent return on equity and a proven track record is far better than a brand new company flaunting a high ROE for a year or two. Ratios can be manipulated, numbers can be dressed up, but durability, you can't fake that. Buffett also warns investors by saying, be aware of business that require only an Excel sheet to look wonderful. One important check: return on equity should be close to return on capital employed. If return on equity is much higher than the return on capital employed, the company might be over leveraged, meaning that high ROE is artificially created by debt. That is exactly where many investors get trapped. They see the high ROE, rush to buy, and later realize that it was just a leverage doing the heavy lifting. This is why studying long term successful companies is so important. Pick 5 or 10 of the best businesses in your country. Study their numbers, check their consistency, compare ROE with ROCE, and you will automatically develop an eye for durability. Ignore banking and financial stocks. As Charlie Munger said, you don't have to be brilliant, you just have to avoid being stupid. So, as your homework, go analyze a few top durable companies and tell me in the comments which stocks pass your durability test.